welcome to the home buying seminar. Thank you so much for joining us today. What I wanted to do is create a home buying seminar that would really educate one in the home buying process so that they would fully understand what things actually look like when it comes to purchasing a home. And there's a lot of questions that go into purchasing a home. I figured, well, if I created a presentation in a seminar that you could watch from the safety of your own home without having to go somewhere and sit in an auditorium, this may be incredibly helpful for you in actually going through the overall process of what things may look like. Now, I'm going to share my screen so you can kind of see my slides here. And the first thing, of course, is looking at the overall buying process. Now, this is presented by myself, and I've been in this industry for nearly 2 decades, roughly 20 years, throughout Southern California, Northern California, and Hawaii. I've been rated as the top 1% of mortgage originators year over year. I've received my education, both bachelor's and master's degree, from Liberty University in Lynchburg, Virginia, and have funded over $1 billion in loan volume. Other notable things is I was a vice president of the Marin Association of Realtors Government Affairs Committee. I was a NAHREP member, founding member of the Petaluma Young Professionals Network, and I've been known to do quite a bit of work throughout the community within my church, whether it be Sunday school or with the homeless throughout Northern California, as well as some work overseas as well. Now, one thing we like to look at is the fact that, and something we're super passionate about is the fact that we like to bring people home. At American Pacific Mortgage, our core mission is to create experiences that matter. It's one of my favorite things that we say as a company is creating experiences that matter. And that means that every interaction with us as individuals in the company is crafted with you in mind. Whether you're buying your first property, if you're looking at investment property, building the home of your dreams, trying to acquire more real estate as far as a portfolio goes, we want to empower you with confidence, knowledge, and solid expertise from the start of that loan application throughout the closing of the transaction itself. Now, the agenda that we have set up for you today would essentially be looking at who we are, what we do, buying versus renting, the anatomy of a loan payment, types of loans, qualifying for a loan, the loan process, and of course, looking at what would then be next. Now, keep in mind, this is what I do, right? So I'm a loan originator. My job is to counsel you through home financing options. What I like to do to start is look at, number one, how high you'd be approved for, great to know, but also what fits your affordability. What is affordable to you? What works for you financially? What fits your budget? And then, of course, working to assist you in finding an option that fulfills your short and long-term needs and goals. And then we work as a team to expedite your financing process. We work with the real estate agent to close successfully. And of course, day by day, we like to answer any questions throughout the process. And then afterwards, I'm done to follow up with you and check in. Of course, real estate agent can help you determine your wants and needs in the home, find homes for sale in your preferred areas, protect your rights as a buyer, really working on your fiduciary duty and really kind of working almost as that attorney, as your advocate in your real estate transaction, of course, negotiating the sale of the property on your behalf. Now, choosing a lender. This is one thing that we get asked a lot. Why American Pacific Mortgage as IA company? Is a couple things that we answer with is the fact that we are a mortgage banker. We are also a broker, meaning we lend our own funds, but we could also broker our funds in-house. We could close a transaction within 12 to 14 days, and we have the ability to actually find the best price product within our relationships of what we call investors, which are big banks that most of you probably already know. And then also we have the ability to broker. We have broker relationships to 25 plus banks and lenders to make sure that we get you the best product we can. So the question that most folks have when choosing lenders, can they provide the program that best meets your financial needs? Are they a mortgage banker or broker? Again, we're both of those things. How long have they been in business? What is reputation? Will they consistently communicate with you? And are all parties involved in the transaction? Will they work together with your agent on your behalf? And will they close your loan in a timely manner? Now, of course, with bankers versus brokers, there's some positives and negatives, right? So when you have a mortgage banker, we get to control the transaction. We have competitive rates and pricing, superior appraisal process because we work with the local appraiser. Now, the negative side of that, of course, is we're limited to the investor pool. Now, if you deal with a bank like Wells Fargo, Chase, with the big banks, if you will, they fund their loans, loan decisions made on customer value. and they handle everything in-house essentially. The negatives, they're more strict. They have very conservative appraisals. They have limited choices on programs, and rates are either in it or out of the market. Now, when you're working with a broker, you have access to multiple programs, access to multiple rate options of various property types. Problem with that, when you broker, is you lack control of the transaction. Inconsistent communication often is what we hear, and they do not underwrite draw docs or fund loans, which is why, again, the mortgage banker model is a model that certainly works. However, there are those cases where we have to broker. That's why American Pacific Mortgage, we can do both. Now, choosing a real estate agent, there's a couple of questions that we generally ask when it comes to choosing a real estate agent. And these are the questions that, we usually get when it comes to, a realtor, right? And the biggest questions are right here. Do they serve the area that you're interested in? Do they have an expertise and experience with the type of property you're interested in? Do they work as part of a larger team? How long have they been in business, and what's their reputation like? Will they consistently communicate with you and all the parties involved in the transaction? Will they work together with your loan officer on your behalf? Because, of course, it's a cliche to say, but teamwork makes the dream work, right? So that's a big thing that we look at, making sure that no matter what happens, they work consecutively with us. And we have a lot of great partners that we like to work with that work incredibly well with us. And we generally work with most people in our markets as well. It is looking at the advantages of buying versus renting. Now, of course, when you buy a property, you have this tax incentive. Now, I'm not a CPA, I'm not a tax advisor, but one thing I go over with our clients once they apply is what that tax benefit looks like. Tax shelter is a rough number. We usually say talk to your CPA accountant or go to irs.gov to verify, but property tax and mortgage interest are tax deductible. Your property investment earns equity, which means that you would create more value over time. In fact, it's proven that you would have 50% more equity in the property itself than those without or wealth, should I say. So your wealth development is now 50 times greater. You have control over improvements to the properties, and then you have that pride of ownership. When you rent, of course, is not tax deductible. There's no equity earned, so you're not really increasing your wealth and cannot make improvements to the property in most cases. Anatomy of a mortgage payment. When you have a mortgage, you have something called P&I, which is principal and interest. Often you have taxes, which are included with the payment, although you may elect, depending on what you're putting down on a property, to have taxes paid separately. They're due in California twice a year, once in November, again in April. And then you have homeowners insurance, which insures the property itself, which gives you a total monthly payment, what we calculate for. Now, if you're putting 10% down or more, you don't have to pay taxes again. The mortgage payment. Now, if you do put less than 10% down, or if you're doing an FHA or VA home loan, it's generally required that the overall monthly payment would then be included. Now, keep in mind, you do also have, you're buying a condo, a homeowners association. And so if there's a homeowners association due, that's not included here, but those vary based off of the condo or townhome that you may be looking at. There's also something called PMI, which is mortgage insurance. Now, if you're buying your property and you're putting less than 20% down, it's often needed to have mortgage insurance, which is not included in this graph here. But depending on the transaction, mortgage insurance could vary, and it's not as expensive as most people think. So that's another thing to think about. In some areas, you may be looking at the need for earthquake or flood insurance, which could make this insurance payment slightly more. Of course, that's where we like to work with an applicant to go over what that actually looks like for you. Several types of loans. One is conventional loans. Now, this needs to be updated candidly, but loan amounts for conventional loans now are up to $1,089,000 in some high-cost areas, such as most of the Bay Area, minus Solano County, which is around $800,000. It allows for programs as low as 3% and can include single-family condos, planned unit developments, which is basically a townhome, or 1 to 4 unit properties if you're looking to use something that we call live in one property and rent out the adjacent units. So government-sponsored loans like FHA, which is a great program for first-time homebuyers, putting 3.5% down. If you don't have less than perfect credit, FHA is usually a very great program. In fact, candidly, my first property that I purchased was with an FHA loan. If you had served in our U.S. military, any branch of service, you may qualify for a VA home loan. That requires 180 days of active service or a certificate of eligibility, which can be found on your DD 214. And then if you're in a rural area, you may qualify for a USDA home loan, which is another government-sponsored loan. Then, of course, there's the question of conforming versus jumbo. Now, keep in mind, this is loan amount driven. It's dependent upon county. And then, of course, this is anything over a conforming loan amount, or what we call a high balance loan amount. Now, jumbo loans could be up to 3 million. I've seen loan amounts even over 3 million, 3.5, 4 million. So depending on the qualifications of the client, it's something that we could look at as well. If you're a first-time home buyer, keep in mind there are a wide variety of programs typically available for those who are not owned a property within the last 3 years. You may qualify for this program, which allows for 100% financing. Now, keep in mind, often closing costs are extra, but if you're looking to put 3 to 5% down, this may give you that 3 to 5% down if you qualify for a first-time buyer program or down payment assistance through one of our entities like GSFA, CalHFA, the Shinoa Fund, or something along those lines. Now, of course, there's the question of, what type of loan. Now, there's fixed rate, which means the payment never changes. The rate's typically a little bit higher than what we call with an ARM or adjusted rate mortgage. It's a more conservative option. Adjusted rate mortgages generally have rate and payment adjust over time. The rate changes basically based off of whatever index that loan is tied to, and it could be interest only for part of the term. The loans, when it comes to our government loans, to break that down a little bit for you, you have FHA, which means it's government insured. You don't have to be a first-time home buyer to use this program, and it has 3.5% down payment, which is required from the buyer, unless if you're doing down payment assistance. There are also renovation rehab loans available called the 2 or 3K program. You can have gift funds, meaning a family member can give you your down payment. There's no cash reserves required at close, and the minimum credit score for 3.5% down is 620. However, there are some FHA transactions which will work as low as 580 or a 550 credit score. The VA, this is for essentially the military veteran and spouse only. So 100% financing. You don't have to be a first-time home buyer. The cool thing about this program is great pricing with no mortgage insurance added to it. USDA, again, 100% financing. Don't have to be a first-time home buyer. It is mandatory. That's within certain market areas, which are rural areas. You can have a gift payment with that. There is a minimum credit score of 640 required. There are usually income limits that apply to this program as well. Now, there are down payment assistance programs in California, as I mentioned. The Platinum Grant, which could provide 3 to 5% of the first mortgage amount. There's no repayment necessary if you don't refinance or sell the property within a certain amount of time. The proceeds can be used for down payment or closing costs. Closing costs are higher than other programs. And again, you don't have to be a first-time home buyer to use this particular program, which is really great. Plus is a zip lien, which provides 3% of the first loan amount to be used on FHA or conventional. 0% interest accrues on that second. Repayment is required when you sell or refinance a house. And if you're a first-time home buyer, you could get additional $6,500 in addition to 3% if you qualify. And first lien has a slightly higher rate and program costs than other loans. Now, qualifying for a loan. A few things to look at. Credit, the willingness to repay, income and employment, which is the ability to repay, assets, which essentially is a down payment, savings for reserves, and of course, property, which would then look at an appraisal. Now, when we look at basically how FICO score is calculated, you have a few things here. Now, 35% of it is the payment history. 15% is the length of credit. You have 30%, which is the owned balance. And then you have 20% of what we call the end use or new credit. Now, keep in mind, if you can keep your credit limits 30% and less, you're going to improve your credit score. So I would say basically try to keep your score at that amount. Your credit score is incredibly important. You have a minimum credit score of almost 600 on most of our loan programs. Some go lower, so you want to ask your loan officer, just ask me, totally fine. But one thing we want to look at is making sure that those credit balances stay low, that payments are paid on time, because that could actually hinder you. We want to also look at, when we look at credit, no open judgments or tax liens. And then we want to see one open and active credit line in the last 12 months. Then there may be specific waiting periods for significant derogatory events like foreclosure, generally is 2 years. Short sale, again, usually 2 to 4 years depending on the program. And then of course, bankruptcy as well. So when we look at this, again, qualifying for a loan with credit. Now, if you're doing a conventional loan on the foreclosure note, I said 2 years, that was for VA, but 7 years for a conventional, 3 years for FHA. Short sale, 4 years for conventional, 3 years with some exceptions to FHA, and 2 years for VA. Chapter 7 bankruptcy, 4 years after discharge, FHA is 2 years after discharge, so is VA. Now, with the Chapter 13, it's 2 years for conventional, 1 year if the bankruptcy payments were made on time and trustee agrees, and 1 year if the bankruptcy payments were made on time and trustee agrees on VA as well. Do mistakes make on your credit score? That's a question we get often. So if you max out a credit card, it's down 10 to 30 points. If your score is 680, if you're 780, 25 to 45 points. But that could actually, believe it or not, be greater depending on how many credit cards that you have maxed out. Now, 30-day late down 60, 80 points. If you're at 680, you have with 780, 90 to 110 points. Debt settlement. So if you sell for debt, it's 45 to 65. If your score is 680, if you're 780, it's 105 to 125. Foreclosure, it's about 100 points at 680 to 160 points at 780. Bankruptcy, it's greater than that, as you see below. And that's, of course, using Fair Isaac's model in an article they produced. So credit improvement. One thing we recommend is reviewing your credit report annually. The second thing is paying your bills on time. Again, going back to keeping revolving credit balance limit below 30%, 10 to 20% of that limit is optimal. So as an example, if you have a credit limit of $10,000, don't let it go over $3,000. Try to keep it under $2,000. Have a good mix of credit, meaning revolving and installment. Installment debt could be student loans, auto loans, right? Credit cards would be like your Capital One card, or if you have an airline card. That's what we call a good mix of credit. Don't close unused accounts. That's a big mistake we see a lot. You don't want to close unused accounts because they actually read that as not knowing how to use credit, and that could actually hinder you. Want to minimize inquiries by applying for credit only when necessary. This is a big thing with us. We do soft credit checks to get folks pre-qualified. When we get you underwritten and pre-approved, of course, it's a full check, but a soft credit check will not hurt your credit. So we try to help you and not have a hard check or bring down your credit score. Shopping for a loan. We usually say if you're shopping around for a loan, focus on the 2-week period. That means you don't have to make inquiries. And again, we do a lot of the shopping for you. But if you do shop, you don't want too many inquiries within 2 weeks. Usually not more than 3 to 5 individuals running your credit. And of course, the last one is use credit sparingly and wisely. On this note, I do have a budget booklet. If you're curious, shoot me a message, and I can definitely give you a full budget booklet that can help you plan out your budgeting goals and help use credit, maybe pay off debt, create a better cash flow scenario for a lot of folks. So let me know if you'd like to copy that. Just shoot me an email or a text, and I'll be happy to send it out. So the next part of qualifying for loan is looking at income and employment, which is essentially that ability to repay. So generally speaking, 2 years of employment is required. Same line of work is preferable. Schooling may count as job history, which means if you've only had a year, maybe even a few months at your current employer, but you went to school for that particular job, we can use that job history or that school history, for your job history. Of course, if we look at commission, overtime, or posted income, we do need to see a 2-year history of receipt. And job gaps may be okay on a case-by-case basis, as long as you're still working in the same industry or there's a reason for that gap itself. Now, self-employment, if you're self-employed, we generally need 2 years to file tax returns. This will be looking at either your Schedule C, your corporate returns. And that's usually if you own more than 25% business, we'll need the full business return. Even if you have a current job, if you have self-employment or side gig or something you're vested in with 25% or more, we're still going to need that. And of course, need some sort of business license or permit or a CPA letter showing that you're still self-employed. Now, keep in mind, there are other programs. Before I jump to this next slide, just, bank statement loans, we have some no ratio programs, which are called non-qualified mortgage programs that one may qualify. So if you don't have traditional forms of income, there may be still programs for you. Now, this question we get often, but how are debt ratios calculated? Looking at essentially the monthly payment versus how much you're spending on the monthly expenditure. So this is looking at Mr. and Mrs. Smith as an example. Their income is $90,000 a year. Their car payment is $500 a month. Buying your property for $350, loan match $332, down payment 5%, 30-year fixed 4.25. And so you look at that. The total monthly payment is there, right? So you can see what that total monthly payment is, where it says PITI, it says 28.7, so it's 28% of the monthly income is that debt to income ratio for what we call the front end. The back end debt to income ratio includes all expenses, and that's at 35.4%. Next thing is looking at assets. So this is what we're going to look at when it comes to your down payment and reserves. So qualifying for a loan, assets, they must be able to verify funds for down payment, closing cost, and required reserves. If you're looking at a jumbo program, the program requires what we call reserves, which is a savings amount on top of what you're putting towards the property. Not saying you have to put an account with us, hold it with your current bank, investment institution, 401k, for example. We just want to verify that there are other funds after closing that you have vested away in a savings account, and that's what we call quote unquote reserves. Sources of funds, again, would be checking, savings, stocks, mutual funds, 401k loans, and in some cases, those gift loans if it's a property you're looking to purchase and live in or occupy as a primary residence. Now, of course, that's what I was mentioning. Gifts, when allowed by the program selected, are acceptable from family members only. We must be able to show a paper trail of that. Is looking at appraisal. So if we look at a appraisal, your appraisal must be equal to or greater than the purchase price. Property must be in good condition unless purchased as a renovation. And certain loans require very specific conditions on that. A property VA loans require essentially all Section 1 items to be done, including mechanical systems feasible and safe, adequate heating, safe water supply and sewer, adequate roofing, basements, crawl spaces, dry, clear debris, and properly vented, safe access from the street, and a little bit more, which would include the Section 1 items as I mentioned. Now, FHA loans, similar, they look at health and safety items. They want to see that the lot is great away from the house. We want to see the egress exterior for all bedrooms, handrails for stairways. Roof is also in good repair or conditions. And they will actually turn on, in a lot of cases, if there's a microwave and oven, they want to make sure that the electricity and property is actually functioning. Well, here's a loan process in a nutshell, right? Working through the loan process. Start is getting pre-approved. So that's where we get the application started. Our application takes 5 minutes, a lot of time. But once an application is done, we'll be able to work through that soft credit check and give just a basic idea of what things look like. And then once you're actually pre-qualified at that point, we want to get you pre-approved. That's what we're going to ask for income and asset documentation. Next step would be finding that property. Find a property you want to make an offer on. Basically reconnect with us. We'll go over the numbers. So you can see exactly what it looks like. Supply the pre-approval letter to your agent. And then also thereafter, we'll actually call the listing agent and talk about how awesome, how strong, and how great of a buyer you are. Then initial disclosure to be sent out. We want those to be signed as quickly as possible so it doesn't delay your closing. That's what's going to allow us to order your appraisal as well. We can't order an appraisal until those initial disclosures are actually signed. For that, your loan goes into processing. That's where we'll ask you to get your insurance agent involved or get an insurance quote. We have a few referrals we can refer as well to help get your insurance quote started. Then you have appraisals and inspections that actually would then take place. Underwriting is the formal underwriting process that takes place. In a lot of cases, might get you fully underwritten. Of course, in an aggressive market like we've been seeing last couple of years, it may help to get you fully underwritten before you make the offer. However, this is where we get you in front of an underwriter, get your file in front of an underwriter, should I say, allow them to fully approve the file itself, and then give us what we call our conditional loan approval. And so after that, we'll get those documents, and then we'll give you a final approval and a closing disclosure. When you get that closing disclosure, it's critical to sign that as quickly as possible. Of course, we could update that, and if there's things that we need to go over, of course, we do that at that time as well. And then that is what creates what we call a 3-day window to actually sign your loan document. You actually schedule loan signing, closing, and funding with the escrow company. And then, of course, escrow company would then call the buyers once docs are received, loan documents, pardon, and schedule that signing to go over the signing. And again, I get involved to go over all the figures, everything you're looking at, making sure that you know everything that you're seeing. All questions are answered. And that's one thing we're passionate about, is checking in with you today, by the way, throughout this entire process. Then after the loan documents are sent out, they're sent to escrow. The CD wait period, as I mentioned, that's why it's so important to get that closing disclosure signed. It takes about 3 days. We want to make sure, of course, you sign that quickly so we can schedule your loan signing, purchase signing, and then you reach what we call the finish line, which is where we celebrate, congratulations, and get you into your new home. So what's next? Finding out is, let's get started and find out what you qualify for, finding out what your needs are, making sure that your needs are answered. We want to get you pre-approved. Comes with that short application. Again, there's a lot of questions on it. I tell most folks, complete their best ability. If you don't know it all, you're completing it. Seriously, you can leave stuff blank. You fill in those blanks once it's done and go over what things look like for you. We start shopping for a neighborhood. We work with your agent to kind of work as that team, that dream team, and putting things together for you as a home buyer. Shop for homes in that particular market. Then, of course, we want to stay in the loop, which is why I check in when you're looking for a home. Not every day. That's when you're in escrow. I usually call every week or so just to check in, see if there's anything you need me to work up for you, any numbers you wanted us to put together, just so you can see what some things look like. Then we close your transaction, right? Once you actually get into escrow, that's the whole period that we just went over. And that's the best part. You get to enjoy your home, which is awesome. So again, we're here to help. Keep in mind, if you need anything, I want to be here to bless you, to guide you, to encourage you throughout the process. Any questions that you have about the market, things that we're seeing, of course, it's a very volatile market. We're here to help with all of that, right? So if you have any questions, of course, here's my information. Definitely let's get that application started. But if you have any questions, we're here to help. So feel free to reach out at any time. Again, I want to thank you so much for working through this presentation with me. Definitely looking forward to working with you and getting you into your new